First, I'm talking about Ind AS 109. It needs to classify that borrowing as a financial liability or equity instrument on the basis of the following features. If interest dividend payable on such borrowing is mandatorily, it is a financial liability. Discretionary, it is a equity instrument. Interest dividend payable on such borrowing is, I need to pay mandatorily interest or dividend payable. Then that instrument is a financial liability. If it is a discretionary, then it is a equity instrument. If such is borrowing is redeemable, financial liability. Irredeemable or perpetual equity. If such borrowing is a convertible in variable number of equity shares of the entity, financial liability. Variable number of equity shares of the entity. If such borrowing is a convertible in variable number of equity shares of the entity, is a financial liability. Fixed shares, fixed number of equity shares of the entity, if it is a compulsorily convertible equity instrument, if it is a convertible at option of the issuer of the entity equity instrument, it is an option of the holder of the instrument compound financial instrument. If any borrowing, if any borrowing by the entity has mixed features of, if any entity, if any entity, if any borrowing by the entity has a mixed features of the financial liability and equity instrument, then it is known as compound financial instrument. Compound financial instrument. Also, for clarification purpose, please note that compoundable financial instrument can be possible only from viewpoint of entity taking money on borrowing, example issuer. For viewpoint of the investor who is investing in preference shares, debentures, equity shares of any entity, the holder, it will be a financial asset only. For example, interest dividend income on financial asset recognized in P&L account. If interest dividend expense financial liability recognized in P&L account, interest dividend expense on equity instrument. See, I'm going to pay interest, I'm going to pay dividend. Where I will charge? I'll charge to my profit and loss account. For example, interest dividend expense on my financial liability. Where I'll charge to recognize to P&L account only. But interest dividend expense on equity instrument is recognized in retained earnings. Retained earnings. So if it is a earning on financial asset, is charged to P&L account. Earning on financial liability, charged to P&L account. Earning on equity instrument alone, recognized in retained earnings. That's what. Recognized in retained earnings. Particulars financial asset or financial liability equity, not a financial instrument as per NAS 109. One by one we are talking now. One by one we will do. Cash and bank. It is a financial asset. Trade receivable, bills receivable. It is a financial asset. Loan given. It is a financial asset. Investment in equity, shares, preference shares, debentures. It is a financial asset. Interest in convertible, irredeemable preference shares, debentures is a financial asset. Security deposit given is a financial asset. See, see, dear friend, in finance IND-AS 109, with respect to IND-AS 109, the primary condition is you need to classify the instrument. There are three kinds of instrument. One is financial asset, another one is financial liability, another one is equity component, and any other instrument which is not coming under the IND-AS 109. What I do? If the instrument is covered under the financial asset, either any interest or dividend on the financial asset, I will recognize it in my profit and loss account. If it is interest or dividend income on the financial liability, I will recognize it in my P&L account as an expense. So either asset or liability, either financial asset or financial liability, either expenditure or income. If it is income, I'll recognize to P&L account credit. If it is an expense, I'll recognize to P&L account debit. But there are interest or dividend expense on equity instrument. For example, during the financial year 25-26, 1,000 crores we declared the dividend. The declared dividend, from where I can declare? Out of earnings. Where earnings available? In the retained earnings. That's what I want to tell you. Now, we want to classify some instruments. Let's go and examples. Cash or bank, what? Financial asset. Trade receivable or bills receivable, financial asset. Loan given, financial. Loan given to someone, financial asset. Investment in convertible, irredeemable preference shares, debentures, financial asset. Security deposit given, financial asset. Property, plant and equipment. It will not covered here because it is ruled by IND-AS 16. Inventory doesn't come in 109 because it is ruled by IND-AS 01, IND-AS 2. Prepaid expenses is covered by IND-AS 8. Advances given for goods and services. This also is not covered under the IND-AS 109. Advances given for goods and services is dealt by IND-AS 115. That's why it's not coming under the IND-AS 109. Investment property is dealt by IND-AS 40. IND-AS 40, yeah, 41 na? Doubt. Let me check. IND AS1 presentation of financial statement, IND AS2 inventories, IND AS7 statement of cash flow, IND AS8 accounting for policies, change in accounting estimates and debtors, IND AS10 events after the reporting period, IND AS12 accounting for taxes, IND AS16 property, plant and equipment, IND AS19 employee benefits, IND AS20 accounting for government grants, IND AS21 effect of change in foreign exchange rates, IND AS23 borrowing cost, IND AS24 related party disclosures, IND AS33 earning per share, IND AS34 interim financial reporting, IND AS36 impairment of assets, IND AS37 provision for contingent, IND AS37 provision for contingent liabilities and contingent assets, IND AS38 intangible assets, IND AS38 intangible assets, IND AS40 investment property. Yes, that's what. IND AS41 agriculture, IND AS101 first time adoption of the IND AS, IND AS102 share based payment, IND AS105 non current assets held for sale, discontinued operations, IND AS108 operating segments, and IND AS109 financial instrument, IND AS110 consolidation, IND AS113 fair value of measurement, IND AS115 revenue recognition from the contract and customers, IND AS16 leases. That's it. So now what I am talking advances investment property. The investment property is coming under IND AS40. It's dealt by IND AS40. So that ignore from IND AS109 perspective. Now, trade payable, bills payable is what? Is a financial liability. Redeemable preference shares, debentures, financial liability. Loan payable in cash with interest, financial liability. Security deposit taken, financial liability. Income received in advance, unearned income. It starts by IND AS 116 leases. Tax liability on or tax refundable. This also covered by IND AS 12. That's why it's not coming under IND AS 109. Now, irredeemable preference shares, debentures with discretionary interest. I issued preference shares, debentures, discretionary interest. As of my wish, either I will pay interest or I don't pay. Then what will be the thing here? Irredeemable preference shares, debentures with discretionary interest. Either I will pay or not. It's my discretionary. Then I could call it is equity instrument. Compulsorily convertible preference shares, debentures with discretionary interest. Yes, equity instrument. Redeemable preference shares, debentures with discretionary interest. So, redeemable preference shares, debentures with discretionary interest is a compoundable financial instrument. So, either it may be equity or a financial liability. Irredeemable preference shares, debentures with mandatory interest. Then it is also a compoundable financial instrument. So either it come a financial liability or an equity component, equity instrument. So compulsorily convertible preference shares, debentures with mandatory interest, compoundable financial instrument. So either it will be a financial liability or equity component, depend upon time to time and situation, but it is a compoundable financial instrument. Preference shares, debentures, convertible at option. Preference shares, debentures, convertible at option is a compoundable financial instrument. compoundable financial instrument. Methods for follow. Financial assets are measured at, there are three. One is amortization cost method, another one is fair value through other comprehensive income, fair value through profit and loss account. So I have a financial asset, but how to recognize, how to measure? There are three kinds of measurements. One, amortization cost method. Second one, fair value through other we will discuss step by step what method, which method, what conditions, what circumstance, which method can be adopted to handle the financial instruments. See, amortization cost method, if intention to hold the asset till the maturity, intention to collect only contractual cash flow of the asset, that's called interest and principal. Such cases, I would like to go amortization cost method. If intention to hold the asset till the maturity, then we will go amortization cost method. Fair value through other comprehensive income. If intention to hold that the asset for some time and sell it before the maturity. The first case, when I'm going to amortization cost method, my intention to hold the instrument till the maturity. In the second case, where I'm going to fair value through other comprehensive income, my intention is not to hold the till the maturity. I want sell before the maturity. That's the reason I would like to go fair value through other comprehensive income. If the next thing is I will go to fair value through profit and loss account. That is the last scenario. In the second scenario, if intention to hold the asset for some time and sell before the maturity. Best example, I bought around 20 equity shares in Tata Consultancy Services. But what I did, when the undervalued the stock, undervalued the asset, at that time I bought that stock, and very recently, because of other stocks was gone up, especially the CDS, Central Depository Services Limited, shares was fallen around, it comes to once upon a time it was 1600. Very recently it's going to trade it at now it's going to, thank you very much, thank you very much. Just revising Anna. Elago, for the because of examination I'm revising, no, so that's why I'm teaching. See, that what I said, that Tata Consultancy Services shares I recently delisted, and I sold that, and I am invested into the CDL, Central Deposit Services Limited. So this kind of attitude of the investments, so I want to sell before the maturity date, then these investment I should recognize it as a fair value through other comprehensive income. Because why this kind of notes going on, it is a financial instrument, and time to time market was recognizing to like high and low method. Then according to IND AS 113, every entity has to adopt the fair value. Now I want to adopt the fair value, but this is a notional gain. It's a not today gain. For example, it's today directly shown 5 lakhs, 6 lakh, 8 lakhs. So drastically high figure. Then we should recognize through other comprehensive income as long as the asset continue as a financial instrument. So once this adapt, you need to be continue till the asset disposal. Once the disposal, it goes to directly to return earnings rather than the profit through rather than the P&L account. So here ultimately what we want to speak, if intention is to hold the asset for some time to sell it before the maturity, the intention to collect contractual cash flow and Anna Jonlagadi Srinivasanna, I am not able to reply your message because I am doing in mobile itself, not doing in laptop. That's why I am not able to reply. That's why I am straight away reply here itself. And thank you very much, my brother. Jonlagadi Srinivasanna. Next, fair value through other comprehensive income. If intention is to hold the actual cash flow from the sale of asset, taking the benefit of the market prices. In such cases, you please recognize other comprehensive income till the asset was disposal. Once a disposal, it directly goes to other comprehensive income to retained earnings rather than goes to profit and loss account. This, once you adapt, you need to be continue. You could not be come back again. So that's is in the fair value through other comprehensive income. Now, the last scenario, I'll go to fair value through profit and loss account. If intention is to hold the asset for trading purpose alone, I bought the shares. See, especially this is applicable to many people that buy the asset and sell the asset, especially shares and equity instrument for future and options trading. So in the case of future and options trading, whatever happened, you please recognize to fair value through profit and loss account, not other comprehensive income, because you want to capture the market price, and then when the market price goes up, you want to sell the asset, right? So if intention is to hold the asset for trading purpose alone, then the better you please recognize in the fair value through profit and loss account. So the intention is to collect the cash flow from the sale of asset, only taking the benefit of the market prices. In such a case, only the following two financial assets are shown at the fair value through profit and loss account. If investment in equity shows any other equity, so derivative financial asset. So what is the note points here? Note point is investment in equity shares of any other entity can be shown at fair value through other comprehensive income. Also in that case, it will be an irrevocable choice. Entity has to follow forever. It cannot be shown this investment in equity shares through fair value through profit and loss account again in the future. See, the moment you bought the equity shares, for example, I am Sriman Narayana, advocate Sriman Narayana Malela, I bought 100 shares in the Infosys. What intention? What is the purpose? I bought equity instrument. Then whatever gain is coming while I'm preparing my P&L, I shown under the other comprehensive income. The moment I go that method, I need to be continue as long as you hold the investments. But in case you consider that investment is a for trade purpose, just to capture the market price and later on you want to sell. In such a case, what India's 109 guidelines to you, you please recognize either gain or loss through profit and loss account. Profit and loss means not directly profit and loss, fair value through profit and loss account. This called either notional gain or loss, you recognize into the fair value through profit and loss account. Of course, it will be disallowed for income tax return filing purpose. While you are filing the income tax return, your notional gain is not taxable, your notional expense also not taxable. So during the tax audit, your tax auditor will be disallow, either notional gain will disallow, notional expense also disallow. Because notional gain is not taxable while filing income tax return, notional expenses also will be disallowed. So anyhow, the moment you charge it to fair value through profit and loss account while filing the income tax return also, it is the advantage to you. Your tax auditor will do properly do. So what India's 109 is telling, the moment you follow adapt India's 109, the properly you recognized either fair value through profit and loss account, either fair value through other comprehensive income. So it will be a good accounting treatment for the notional gain and notional expenses with the corresponding to the market value, whatever the shares and debentures held the instrument as a financial instrument. But whereas fair value through other comprehensive income teaches once you adopt, you should carry the till the asset disposal. You could not be withdrawn in the middle of the year. That's you should be remember in your brain. But once you follow, you have to follow till the end. Irrevocable choice regarding to fair value through other comprehensive income option. Whereas you decide rather than equity instrument, rather than as a uh, like trade purpose to capture the market price and sell, then you better to be follow fair value through profit and loss account only. So what I want to say, financial liability are generally measured at amortization cost method only. Financial liability are generally measured at amortization cost method only. Only following two financial liabilities should be measured through fair value profit and loss account. Now we would like to talk one by one which method, one by one method. In the deliberately and elaborately we'll speak about amortization cost method and fair value through other comprehensive income, fair value through profit and loss account. These three methods we will talk elaborately, and then we'll gain the subject matter of the knowledge. See what author is telling, the note point is investment in equity shares of any, in that case it will be an irrevocable choice. If entity has to follow forever, it cannot show this investment in equity shares of the fair value through profit and loss account. So the moment you are investing, you need to understand whether I am going to till the maturity, whether I am going to do trade. If I am going to do trade purpose, then I would like to go fair value through profit and loss account. If I would like to be continue till the maturity and then once market is gone up and then I want to sell, that's I need to go fair value through other comprehensive income. Whereas generally most of the people will buy the shares and they want to hold till the maturity. In such cases, you better to follow fair value through other comprehensive income, where the people decides buy and sell, consider as an investment for the trade purpose alone. You bought an asset, you sell an asset. You bought an asset, sell an asset. So in such a case, you better to follow fair value through profit and loss account recognition. If you do this accounting aspects, your income tax return filing, you will give correct adjustment. Otherwise, income tax auditor, whoever may be filing, they do mistakes. In such cases, you will get the notices that will be leads to complexity. So don't want to do that. You need to follow India's 109. You need to give better explanation to the assessing officer or maybe whoever may be given the notice, maybe scrutiny assessment, income assessment. You will be properly explained to him regarding to India's 109 and whatever you done treatment, so that it will be problem will be solved. Now, I would like to talk about detailed and elaborately regarding the amortization cost method, fair value through other comprehensive income, fair value through profit and loss account. Each these three methods we are going to talk now elaborately. The amortization cost method. See, amortization cost method, under this method, entity shall do accounting is as follows. How they do accounting? Entity shall initially recognize the financial asset or financial liability at the fair value adjusted with the transaction cost. So, for example, today I issued equity share, I issued debentures at 100 rupees of debenture, I issued at 95 rupees. But what is the fair value? Fair value is 100. But I issued at 95 rupees. So what is the fair value here? Fair value is 100, no? Yes, 100. Then I issued interest rate at 10%. But effective interest rate in the market is EIR rate is 13% or 14%. Then why, while I'm doing the calculation in my profit and loss account, even though I recognize 10% on the 100 rupees, no, you should recognize the effective rate of interest. And then whatever the difference, you understood, for example, you take 1 lakh rupees of debentures. I issued at the 95 rupees and interest rate is 10%, whereas effective rate of interest in the market is 20%. Now, what is do the accounting people? If transaction is done at market price, only effective interest rate is given, then amount received given is considered as a fair value. So what we do generally, because I issued at 10%, then that 1 lakh into 10%, how much will be? 10,000. These guidelines to you, you should not recognize 10%, you should do it 14%. You should do at 20, whatever food in the market rate, that rate you need to do. Then the difference calculation will come, that will be charged to P&L account. So that method we are going to talk now. That method we are going to talk elaborately. See, if transaction done at market terms, only effective interest rate is given, then amount received are given in considered at a fair value. For example, if transaction done at off market terms, market interest rate on similar instrument is given in the market or maybe in the question. So calculate the fair value by discounting the future cash flow using the market interest rate on similar instrument, present value of the future cash flow. See, why we are talking a lot about the market rate of interest? Either you need to create a provision in the profit and loss account, you need to bring it into the present value. That present value bringing interest rate, not the rate which you should consider the market effective interest rate, EIR method, EIR rate. That rate you need to bring into the present value and then recognize to your financials, so that it is easy to repayable at the time of the maturity of the instrument. So that's why if transaction is done at market terms, you please recognize effective rate of interest. If transaction done at off market terms, the market interest rate on the similar instrument, for example, you issued debentures. For example, I issued calculator. On the calculator, one if issued to the market, the how much other people are charging, that price, that interest, I need to recognize, and then I need to bring into the present value, and then I need to calculate it and made a provision to my financials. So calculate fair value by discounting the future cash flow using the market interest rate when you are going off terms of the market. So on the similar instrument, so bring into the future value, present value of bring into the future cash flows to the present value. So the entity shall change interest expense on financial liability or interest income on the financial asset at discounting over the period of unwind the discount. So for this one table, year one, and opening balance of the financial asset or liability, interest, discounting rate, and actual payment of interest, then closing balance. So this is the table you will calculate. Table in the table, first column year one, second column opening balance of the financial asset or liability, third column interest, discounting rate. Discounting rate means what? Not which rate I issued, the effective rate of interest in case of market terms. If it is done by off market terms, the similar instrument, what interest rate is recognizing in the market, that rate I need to put here, so that I need to be calculated. Then actually how much I pay? Actually I will pay at the 1 lakh into 10% is 10,000 every year I will pay that. Then closing balance will available. So this is the way you need to be amortized over the period of time regarding to your financial instrument, either maybe financial asset or financial liability will happen. Now, discounting rate to change interest over the period. So if transaction is done at market terms, yeah. If transaction done at off market terms, market interest rate on the similar instrument. In this case, if transaction cost is given in question, then EIR will also be in question. Then hence you use EIR to unwind the discount in such case. Now, for this journal entries, what will happen? My dear friend, journal entry will happen like this. For financial asset at the beginning of the year, financial asset account data to bank. Okay. So at the beginning of the year, there are two kind, right? One is financial asset, another one is financial liability. Whereas a financial asset, how will you do a beginning at the time of the beginning of the entry financial asset? What will you do? You need to recognize the asset because you paid the amount. So financial asset account data to bank. Whereas it is a liability for you. Then what will you do? Beginning journal entry. The beginning of the year journal entry will be bank account data to financial liability. So this is a one. Next, at the end of the year, what I will do? I will do financial asset account data for unwinding of the discount and to finance income. For example, if I am following if it is for me is a financial asset account data to financial income. So P&L. So for unwinding discount, what I need to do? I need to recognize interest income no on my asset. Then what I will do? Journal entry financial asset account data to finance income that goes to later on P&L account that finance income. So then next what entry will become? The bank account data to financial asset. So interest component will come. So one is for unwinding discount charge to P&L account. Another one is for actual installment as interest or principal installment received for that. For that is entry is the bank entry, bank account data to financial asset. For that interest portion is receiving financial asset account to financial income P&L account. So now, whereas a financial liability, how will you do accounting entry? At the beginning, bank account data to financial liability. At the year end, finance cost to financial liability. So finance cost, what happened? It goes to charge to P&L account. The beginning of the year, what journal entry? Bank account data to financial liability. At the end of the year, what I need to do? The financial liability, you need to pay interest. No, you need to be recognized. No. That's why finance cost, which goes to P&L account, data to financial liability for unwinding discount portion. Now that you are going to pay financial liability, either interest or principal, both together. So financial liability account data to bank. These are the journal entries of the financial asset and financial liability. Now, note points. Either in the rate at which present value of the future cash flow from the instrument become equal to the net cash flow at the beginning. See, EIR, effective interest rate, the rate at which present value of the future cash flow from the instrument become equal to the net cash flow at the beginning. So you go through EIR method. Ultimately, what happened? Equal to the net cash flow at the beginning. It will be the beginning question generally, otherwise calculated using trial and error method. Now, see, EIR is the rate at which your present value of the future cash flow of the instrument become equal to the net cash flow of the beginning. Why? Because after 10 years I am going to pay 10 lakhs of money, but the 10 lakhs of money with effective rate of interest I need to bringing into the present value of today, and I charge to my P&L account, and that every year I need to charge an interest. It needs to be added to the interest in case of a liability. Payable, it has a liability. In case asset, it is an income. So you understood? After 10 years, I'm going to pay around 20 lakhs to you. That 20 lakhs today I need to recognize in my books of accounts because I want to make a provision which going to be maturity value of 20 years. I'm going to pay. That's why suddenly if at that time if I'm going to pay 20 lakhs, how can I pay without creating a nice provision? For that 20 lakhs today I need to recognize in my financials at the value, and the value into effective rate of interest if every year goes at the end, that 20 lakhs equal to this value, the cash flows all together will be equal to the 20 lakhs. So this kind of thing should be happen. Now that's why the note point is AR is the rate at which present value of the future cash flows from the instrument become equal to the net cash flow at the beginning. It will be given in question generally. Otherwise, calculate using trial and error method which rate of interest is going to be added of your liability or asset. It should be equal to the matured value which you want to pay or receive. Now, the transaction cost include regulatory fee charged for the discount. Sorry, document. Transaction cost include regulatory fee, charges for the document preparation, processing, brokerage fee, upfront fee, etc. It is added to the fair value of the financial asset at the initial recognition. It is subtracted from the fair value of the financial liability in initial recognition. So, what I want to tell here, for example, you took 1 crore loan. For that 1 crore loan, only 1 crore he will charge. No. He will charge you document charges, brokerage, regulator fees, whatever stuff. That's called upfront fee. That's called upfront fee. That should be added to the fair value of the financial asset at initial recognition itself. At initial recognition itself. If it is a asset, you please add it. If it is a liability, you should recognize. If it is a asset, that upfront fee added to the fair value of the financial asset at initial recognition. If it is a liability, then you please subtract from the fair value of the financial liability at the initial recognition itself. So the difference will be recognized in the journal entry initial recognition as follows. If there is any special relationship between the parties in the transaction, यार somebody phone. Hey, పోయిందా? Sorry for your disturbance, my YouTube watch you what YouTube viewers, YouTube watch viewers. See, the transaction cost includes regulatory fee, charges for document and preparation for processing and brokerage taken. All these called as upfront fee. For in the case of financial asset, you please add to the asset. In case of the from deduct from the fair value of this upfront fee. So if transaction done at off market, the terms, then there will be a difference between amount received or paid at the beginning of the fair values calculated at the beginning. This difference will be recognized in the journal entry initial recognition as follows. How? How? Like this. For example, employer to employee, loan at concessional rate is given to employee. Then employer prepaid staff cost for employee advance salary income. So write off over the period of the loan in profit and loss account as per Ind AS 19, not 109. Ind AS 19 talks about employee benefits. Ind AS 109 talks about financial instruments. So here, the loan at concessional rate given to employee prepaid staff cost for employer. For employee, it is advance salary income. Write off over the period of the loan in P&L account as per the Ind AS 19. For example, same information, it will happen to lessor and lessee. Security deposit given to lessor. For lessee, it is recognized as like ROU, right to use of asset, like a prepaid lease rent. For lessor, it is a advance lease income. For lessee, it is a ROU asset. For lessor, it is advance on the lease income. So write off by charging depreciation, write off by charging depreciation in P&L account over the period of the loan as per Ind AS 116, not as per Ind AS 109, friends. Because it is covered under the lessee, that is covered under the employee to employee. This is covered under the lessor lessee. So in between employer and employee, I woke up for the Ind AS 19. If I'm between lessor and lessee, then I woke up for Ind AS 116. Now, the similar thing happened between parent and subsidiary. In such a case, the parent company is providing loan to subsidiary company. Parent investment in subsidiary. For subsidiary, it is a equity capital contribution from the parent. Then treatment as per Ind AS 27 and 110, not as per Ind AS 109. Subsidiary company is providing loan to parent company subject to dividend distribution. So the loan parent to company, for subsidiary it is a dividend distribution, for parent company is a dividend income. So recorded in retained earning 09. Dear friends, let's take few examples of this. We'll solve now. For example, transaction at market terms. For example, A Limited issued 10% of the debentures. The face value is 1 lakh at 94,000 rupees. So interest is paid annually. It will be redeemed at the end of the third year. Okay. At the end of the third year, I'm going to do redeem. So now, pass the journal entries for first year given present value factor. The present value factor 12 percentage, year 1, year 2, year 3, 0.893, 0.797, 0.712. These are at the rate of 12 percentage. At the rate of 15 percentage, year 1, 0.895, year 2, 0.783, year 3, 0.673. Now, the solution calculation of the EIR by using trial and error method we'll see now. See what cash flows will happen. Always on 1 lakh debentures, how much I need to pay interest? 10%, right? Yes, cash flow will be 10,000, 10,000, 10,000. But year 3, I'm not paying 10,000, I'm paying 1 lakh 10,000 because year 3 I'm going to redeem. Now, the present value factor, if I go 12 percentage, then I bring to today, the present value is coming around, if I multiply with my cash flows into present value factor 12 percentage, then my flow is coming to around 95,220. But present value, if I go for 13 percentage, then my present value becomes 92,910. Now, do interpolation between EIR at which present value there is a cash flow about 94,000 will happen. Yes, 95,000. Just a minute. Sorry for your inconvenience. See, sorry for your inconvenience because one client called me in the juncture of its in online and I answered this. Transaction at market terms. దేవుడా టైం అయితే గాడ్ టైమ్ ఈజ్ ఓవర్ షిట్ అయ్యో okay, don't worry Simar, concentrate. Okay, how to calculate EIR? If you given EIR, you will use EIR, fine. If effective interest rate is not given, see what happened here. I want to pay you 1 lakh after 3 years. Okay, but that 1 lakh, how I need to pay the 1 lakh? Every year what happened? Every year 10% of interest I need to recognize. 10,000, 10,000, 10,000. And last year 1 lakh plus 10,000 I need to pay. Yes, right. But unless otherwise, I need to recognize today in my P&L account as a provision. I cannot pay your liability at the end of the third year. Am I right? So that whatever I recognize today, hold together at the time of paying to you, it should be equal, right? For example, I'm going to pay 3 years after 1,10,000. But today I'm creating a liability into interest rate. Consider for 3 years, all together should be 1,10,000. That much of amount I need to recognize today. That's why what rate of interest I need to use? If I use book rate 10 percentage, may not be equal to my future flows to the present value of the future cash flows. So that what rate of interest I need to use? I need to use the effective rate of interest. Effective interest rate I need to recognize. Calculation of the effective interest rate by using trial and error method. So during the calculation of the trial and error method, like how compute IRR, what will happen? Present value of the cash flows inflow is equal present value of the cash outflow, that is called NPV, right? Likewise, I need to calculate rather than IRR, I'm going to calculate EIR. So EIR is equal to 12 percentage plus present value of the outflow at 12 percentage rate minus actual discounted flow 94,000 divided by, see, if I calculated at the rate of 12 percentage, my outflow will be 95,220. Whereas I calculated at the rate of 13 percentage, my outflow will be 92,910. Now 12 percentage plus 95,220 at the rate of 12 percentage minus 94,000, which was issued at the 10 percentage, divided by 95,220, which was at the rate of 12 percentage. Concentrate on exam, Sriman. Let's go. Now, then we did the interpolation to find the EIR at which present value of the future cash flow of 94,000. To calculate interest expense, the finance cost on the financial liability account, the opening balance of the debentures 94,000, interest, see, after done interpolation, EIR came at the rate of 12.536. Now, the calculation of the balances at interpolation rate 12.536. So, opening value 94,000 applied at the rate of 12.53. How much is coming? 94,000 into 12.53 percentage. Then 11,778 came. Then 11,778, if you add it to 94,000, you should pay 1,05,778. But actual payment, how much you done? 10,000 minus 10,000. Then 95,778 year beginning value. Then subsequent year 95,778 again 12.53%. Then 12,000, then 10,000 your actual paying. Then again 97,778. So at year end, year third, the closing value which you go to pay 97,779 and applied 12.23 interest rate, then How much is coming? 97,779 into 12.53 percentage. Then 11 lakh, 1 lakh 10,000. Now at the year third, I'm going to pay 1 lakh 10,000 only. So my closing liability is zero. So this is called amortization table, my dear friend. This is called amortization table. Now, what's the journal entry for this? The journal entry for this at the beginning, bank account debtor 94,000 to 10% debentures financial liability 94,000. Interest expense. See, bank account debtor to 10% of the debentures is a financial liability 94,000. Interest expense P&L account debtor, interest expense P&L account debtor to 10% of the debentures. How much? First, what happened? I received 94,000, right? 94,000 I received for a discounted value of 94,000. Now, bank account debtor to debentures 11,778 first year interest on 94,000 at EIR rate 12.53 percentage. Account debtor, interest expense account, which is goes to P&L account debtor to 10% of debentures 11,778. Now, next, 10% of debentures account debtor to bank 10,000, 10,000. So the interest expense 11,778 account debtor which goes to P&L account to bank 10,000 to 8. Interest expense P&L account debtor 11,778 to bank account 10,000 to 10% of debentures financial liability 1,778. Dear friends, now time is 2:20. I am going to lunch to my home. I'll come back to around 2:40 or 3 o'clock. Then we'll start remain part of India's 109 will complete. Today target is Today our target is to complete 5 standards. What are those? What are those standards? 5 standards. Already yesterday complete India's 110. Today we are going to plan India's 109. India's 115 also planning. India's 103 planning. India's 102 planning. India's 116 completed revision planning. India's 16 already done again planning. These are 7 standards. We are going to revise once again today. If time permit, we are going to solve problems and solutions. My dear YouTube watch viewers, thanks to you. A thanks lot to watching my channel. You please comment and subscribe. Give back. Also, I happy to receive your comment. Thank you, wonderful. Bye bye. See you, Tata.